The truck driver's dashboard glows with the news. Record corporate profits, soaring markets, another banner quarter for shareholders.
$8 billion wiped off the exchange today.
$136 billion was wiped off.
$5 trillion in value had been wiped from the markets in just 3 weeks.
He calculates his paycheck against this month's grocery bill and comes up short, again. This isn't an isolated tragedy. It's the mathematical inevitability of an economy that spent 40 years perfecting the art of concentration. Look at the data and you'll see something unsettling. Median wages flatlined around 1980 and never recovered their upward trajectory, while stock prices launched into orbit. Some economists point to AI and technological promise. Others see wealth accumulation driving asset inflation. But a growing chorus of researchers and populist politicians across the ideological spectrum identify a more fundamental culprit: the systematic consolidation of economic power into fewer and fewer hands. Bernie Sanders frames it bluntly: sector after sector controlled by a handful of giants, engaging in coordinated price manipulation. But doesn't basic economics teach the opposite? That efficient innovators like Amazon, Microsoft, and Nvidia deserve their dominance because they outcompeted inferior rivals? To untangle this paradox, I turn to Professor Jan Eckhout, whose book, The Profit Paradox, documents a transformation most economists missed. Market power, the dominance of large firms, has increased dramatically, he told me. The implications ripple through everything: wages, prices, innovation, opportunity itself. The encouraging part? We already know how to fix it. So what actually happened? Rewind to the early 1980s, and you'll find a corporate landscape that looks almost quaint. Profit markups sat at historic lows. Stock markets languished near their worst valuations ever. Then something broke. Both markups and equity valuations didn't just recover, they achieved escape velocity. What changed? 4 interlocking forces, 2 that made companies naturally larger, and 2 that made them unnaturally profitable. This distinction matters enormously, because size alone isn't necessarily pathological. Profitability disconnected from productivity? That's where the diagnosis gets grim. The first force was the technology revolution. 1980 marks the moment when society began truly using computers, Eckhout explains. The 90s brought the web. The 2000s, mobile technology. The 2010s, big data. This isn't a single disruption. It's a cascading evolution. Digital technology introduced economies of scale on an unprecedented level through fixed costs versus variable costs. Think about it this way. Building a plane requires materials and labor for each unit, variable costs. But Boeing must first invest years in research and factory construction, fixed costs that remain constant whether you build 1 plane or 1,000. Produce a single aircraft and you must recover millions from one sale. Build 1,000 and you amortize that investment across your fleet, driving per-unit costs toward just the variable expenses. A furniture maker needs only tools and workspace, modest fixed costs recovered after selling a handful of chairs. An aerospace startup needs billions before selling anything. After World War II, most developed nations had a few aircraft manufacturers. Today, Boeing and Airbus. Digital technology raised fixed costs while enabling unprecedented coordination of global supply chains. This dynamic went thermonuclear for industries created by the digital age, operating systems and social networks with essentially zero marginal cost per additional user. But technology alone doesn't explain the transformation. The second force hit simultaneously: hyper-globalization. Previously, manufacturers could only grow so large before exhausting domestic demand. Globalization removed that ceiling. To remain viable, companies had to scale globally or die. So these twin forces explain why firms grew enormous. But here's what's wild. They don't explain why these giants became so extraordinarily profitable. Free market theory predicts that excessive profits attract competitors who drive prices down. Yet reality delivered the opposite. Firms grew larger and more profitable while startup formation collapsed. Why? The answer lies in 3 mechanisms that locked in monopoly power. The first lock came from network effects. I value a social network because everyone is on that network, Eckhout explains. There's no point in having 2 equal social networks. You'd consider switching from Instagram to a privacy-respecting alternative, except your friends are all on Instagram. Each faces the same calculation. Coordinating mass migration is nearly impossible. So platforms can degrade service without meaningful competitive pressure. The second lock operates through strategic acquisition. When competitors emerge, dominant firms simply buy them. Facebook acquired Instagram. Match Group absorbed Tinder, then Hinge. Research on pharmaceutical acquisitions reveals the pattern. When dominant firms buy companies developing competing drugs, those projects frequently vanish. The official explanation involves portfolio optimization. The real explanation is killing competition before it matures. Warren Buffett describes his ideal investment with revealing candor. "I want a business with a moat around it, a very valuable castle in the middle, and a big moat protecting it. The moat enables pricing power. When you're insulated from competition, you charge what you want, generating extraordinary returns." The third lock was policy, the collapse of antitrust enforcement. During the 1950s to 70s, America enforced vigorous antitrust regulations. Then, economists successfully promoted a new doctrine: markets self-correct, and higher profits merely reflect superior efficiency. Antitrust enforcement withered. The guardrails came down precisely when digital technology and globalization made them most necessary. So that's what happened in 1980. Digital technology and globalization increased firm size, while network effects, acquisitions, and weakened antitrust made dominant firms extraordinarily profitable. Stock markets reflected this bonanza. Wages didn't, but maybe this is fine? Perhaps monopolies engage in questionable practices, but they're genuinely innovative. Here's where the research gets troubling. Eckhout's work identifies 4 channels through which monopoly power degrades economic performance. First, monopolies charge super-competitive prices, creating a second-order effect. Higher prices mean lower demand, less production, fewer workers hired. When this repeats across industries, total labor demand falls, reducing worker bargaining power economy-wide. Productivity and wages used to move together. Since 1980, that link shattered. Productivity continued rising. Wages for typical workers stagnated completely. Beyond wage suppression comes the inequality amplifier. As dominant firms expand, they compete ferociously for superstar talent. A marginally better algorithm can generate millions in monopoly profits, so tech giants now pay millions to elite AI engineers. The market still works for those at the very top. It just stopped working for everyone else. Here's where intuition breaks down: the innovation paradox. These dominant firms invest heavily in R&D, but as Eckhout explains, 100 small firms with combined size equal to 1 large firm jointly innovate more than the single giant. Innovation actually declines with firm size. Monopolies innovate enough to maintain their position, not enough to maximize societal progress. These effects compound: higher prices, suppressed wages, increased inequality, reduced innovation. They interact and amplify. The whole system begins eating itself. So if monopoly power damages economies this severely, what's the remedy? Eckhout points to professional sports. We organize sports to ensure a level playing field. You need a referee, enforcing clear rules that promote competition. Without salary caps and draft systems, the richest teams would win every championship. Sports leagues figured out that you need artificial constraints to maintain genuine competition. Translating this to economics means reviving antitrust enforcement, adapted for modern technology. One promising approach: mandating interoperability. Try sending a message from WhatsApp to Telegram. Impossible. Why? Because interoperability threatens network lock-in. But what if we forced platforms to accept each other's traffic? Separate the network, your contact list, from the operation, the app's features. Suddenly, Signal and Telegram could compete on service quality rather than network size. Does this actually work? Europe's high-speed rail provides the empirical answer. European Commission regulations forced national rail operators to allow competitors onto their infrastructure. A Spanish company can now run trains on French tracks, paying regulated usage fees. The network remains monopolistic. You can't duplicate rail lines, but operations became competitive. Ticket prices dropped 28% within 9 months. Lower fares increased ridership, boosting demand and encouraging operators to hire more staff. Many problems we discuss regularly, inequality, inflation, stagnation, may share this common root: the collapse of competitive markets. This matters politically because restoring competition might be more feasible than alternatives like wealth taxes. It's not about punishing success. It's about maintaining the conditions that make success possible for more than just the incumbents. Yet here's the paradox we can't ignore. The same business tycoons who benefit most from monopoly power now wield unprecedented political influence. They fund campaigns, shape media narratives, and literally advise governments. Asking them to voluntarily surrender their moats is like asking medieval lords to democratize their castles. So perhaps the real question isn't whether we can restore competition. The policy tools exist, the economic evidence is clear, the historical precedents are documented. The question is whether we will, whether democratic institutions can reassert control over market structure before concentration of economic power makes such reassertion impossible. The truck driver finishing his shift doesn't have that answer. Neither do I. But I know this much: the numbers tell us what's at stake. An economy that works for participants rather than just shareholders, wages that track productivity, prices that reflect costs rather than market power. We built competitive markets before. We just need to remember why it mattered. Can we restore genuine competition? Or has the concentration of wealth and power already made that battle unwinnable? At Market Media, your opinion matters to us. Share your story in the comments below. Don't forget to subscribe and like the video.